Before we get started, allow me to introduce our speaker for today. He is David Ng. He has extensive experience in the derivative industry. Formerly, David was the head of marketing in Philip Futures, where he is leading the marketing team in growing the derivative industries. Currently, he is a full-time proprietary trader with Iceberg X, which is a local proprietary trading company firm in the local futures market. Without further ado, let me pass the presentation to David.
Okay, thank you very much. Thank you, CY, for the very kind introduction. And just like to thank everyone who participates tonight's webinar. Hopefully, you guys have had your dinner. So just before I start, just like to thank Excellent as well as Bursa Malaysia for inviting me to speak on today's platform entitled "Capitalizing the Futures Market Using Spread Strategy." Now, I think when it comes to spread trading, there's a lot of confusion. And there's always a myth saying that whenever we trade spreads, it's only cater to those who are very well in depth in the market or very well professional. I like to say that that's not true. In fact, spread trading is getting very popular. Reason being is because the benefits of it, and also all in all, is actually require a lesser margin. So therefore, it's actually gives you a lot of opportunity in the market. So I'm just going to elaborate more today's topic more on using spread as a way for you to enhance your trading journey. And if you have been trading on the Bursa Malaysia derivatives market, especially on a CPO contract, you're well familiar with the outright contract. Spread trading can add or even enhance your trading strategy. So just before we start, as usual, risk disclaimer. I think anything I presented here today is purely based on educational purpose. Dealing with derivatives or futures or any other derivatives contract does involve a fair amount of risk. So make sure you do consult your licensed representative. So any views as presented here are purely based on my personal opinion and my view. It doesn't represent any views by Excellent or even by the exchange itself. Do make sure that you consult a licensed representative before you kickstart any journey with regards to the derivatives market. So this is the agenda for today's webinar. So at least for the next an hour session, we probably will be talking about just introducing to you the basic what is spread about, and some basic trading strategies that you can use whenever you're trading the spread contract. And I think trading spread requires a little bit, or rather I would say a slightly different strategy as you were doing the outright contracts. Like if you are trading a CPO market right now, whenever you're involved in a spread market, it does involve certain types of trading that you might differ from your normal trading pattern. And I think when you trade spreads, it is important for us to also look at fundamentals. There's always a saying, fundamentals, prices tend to react faster than fundamentals, or whatever prices has already discount fundamentals. There's certain truth to it. But I think nevertheless, if you are doing spread trading, it's always important for you to understand there's certain fundamentals in play. So later on, I'm just going to share you why fundamentals is important to understand spread trading, because in whenever you're dealing with commodities, there's always seasons. As if you've attended my talk earlier, I did mention that whenever you trade CPO market, there's always a season that prices will tend to be stronger. There's always a season prices tend to be weaker. So spread itself, whenever we talk about seasonality, it's important to analyze that because it does affect your spread movement as well. So understanding fundamentals and seasonality is an important criteria whenever you are trading the spread market. So last but not least, I think same as how you trade outright, I think you can apply technical tools and certain technical analysis whenever you're doing spread. So not necessarily that you just have to look at the spread dynamics itself. You can also apply technical tools, and some technical strategy that you can employ whenever you're doing spread trading. So just a very quick introduction to what spread trading is all about. So a lot of people has misconception that if you are doing spread, you need because the confusion is you are doing two products or two different contracts at one time. So tend to get a bit confusing. But ultimately, spread trading is telling you that you are simultaneously either buying one contract and selling the other contract. It could be different months, it could be different product, it could be even different markets. So eventually, I think what you are trying to do with spread trading is that you are trying to play, or you're trying to gauge the spread between the prices of two different contracts or different months, or two different products or two different markets. So eventually that spread. And in a way, I think a lot of people do like trading spreads because it does require lesser margin overall. But because you are buying one contract and selling the other contract, indirectly you are actually getting lesser exposure of a risk compared to if you are just having whether you are long one long position in the market or one short position in the market, you are exposed to the market in general. So in a way, spread does reduce your overall risk. But then again, as with regards to any derivatives market, if you don't have a proper risk management, you could get affected whenever there's a wild swing in the market, which is quite common recently because the market is actually getting very volatile. So spread trading is also getting quite volatile. So naturally, you still need to have a proper risk management in place whenever you are trading spreads. So basically, I think when you trade spreads, you're talking about a difference in value, and that's what ultimately you're trying to you'll be trading about. And trading spreads in a way is also help you to manage risk. Like I mentioned, you're holding two different separate positions at one time. So you are exposed to a market. You're not so exposed to the market as compared to only having one position or single position at the market at any point in time. So trading spreads itself does reduce your risk overall, and in fact, it's actually well better managed. So there's two common ways, or rather techniques, that you can trade spreads. One of it is what we call mean reversion. So a lot of traders who trade spread, they always think that, oh, okay, the spread seems high, I'm just going to short the spread, or what we call a bear spread strategy. Hopefully that the spread eventually will return back to its mean. So that's mean reversion. Swing trading, on the other hand, is that whenever they notice that the spread starts to widen and tend to get a view, so normally they'll hold a little bit longer than usual, and hopefully to capture the whole swing of the market. So these are the two common trading techniques that one can use whenever you're trading spread. So in terms of type of spreads, there's actually three major types of spread. So I'm not going to go every single type of spread today. I think the major focus for our discussion today will be mainly on the intra market, or what we call calendar spread. So there's three major types. The first type is calendar spread. So in CPO market, later on you're going to see in the Bursa Malaysia Derivatives Exchange, we have total about 24 contracts, all to forward months. So calendar spread is basically talking about the difference between September price against the October price, for example. So that's calendar spread. We also have the other type of spread, which is intermarket spread. So intermarket involves different commodities. So in this sense, we have, for example, if you are doing crude palm oil, one of the related product is soybean oil on seaboard. So what we can do is that if you notice that the spread is starting to widen, or the premium starts to get wider, you can long the CPO market or short the seaboard market. So that's how we refer to as the intermarket spread. Last but not least, this inter-exchange spread. So it's the same type of product, but listed on different exchanges. I think one good example is that if you're trading wheat, there's two different exchanges. One, we have the CME exchange, and another one is the Kansas City. So ultimately, it's the same contract, but it's listed on a different exchange. There's still a price difference. So that's where a lot of arbitragers they tend to arbitrage between these two products. So that's what we call inter-exchange spread. It is not common, but again, I think based on a general principle, just to understand the definition of spread, these are the three major types of spread that's available in the market. But what is important and what's crucial is that the intra-market, which is the calendar spread, should be the focal point of our discussion. And that's where we will be focusing majority of our discussion today. Now, the essential of spread trading. Now, because of the proper definition of spread is that you are involving two simultaneous transactions. One is to buy, the other one is to sell, which is a reverse scenario. And that usually what we call a bull spread. So a bull spread normally will tells you is that if you have a view that the spread of this particular commodity is going to go wider, the price difference is going to be even higher. So technically what you should do is that you should be doing a bull spread, which means that you're buying a front month and you're selling the far month. So that's how we usually engage in the spread contract. Now, the vice versa also applies. If you are thinking that the spread will narrow eventually, then what we can do is that you should be shorting the front and buying the far month, hoping that the spread eventually will narrow substantially. So that's how you should be looking at spread. So in a way, if you are looking at spread to widen, normally what you do is that you should be longing the front position, and you should be shorting the next or forward or further months contract. So in this sense, is that the spread will get wider. Now, vice versa, if you are thinking the spread is going to narrow in for several days or weeks, what you can do is that you should short the front month and buy the far month. In this scenario, it's called a bear spread. Eventually, you're hoping that the spread will narrow substantially. So again, this is how the spread dynamics works. But essentially, what you need to know is that when you are doing spread, one position will be long and the other position will be opposite of that position. So in a way, your risk is much minimized. That's because you're holding opposite position in one pair. As compared, if you're holding just an outright position, you're exposed to the overall market direction, and that's where one of the key benefits of doing spread is that it's actually it reduce your risk exposure. Now, so just to give an illustration and to make just to give you a bit of clarity. So if you look at calendar spread, we always refer to when a pair, and in this pair you have different contract months or different months itself. The front month, or what we call the near month, is usually the periods that we are closer to where we are trading now. The far months are usually referred to contracts that's further or what we call the next couple of months. So very simple. If you think that the near month contract is going to rise higher and the far month is going to fall, maybe because in the next couple of weeks or months, you probably will see prices tend to decline because supply is coming back. So in this case, the spread will get wider because the front month is going to rise, the far month is going to decline. So in this case, what the action should do is you are intentionally trying to do is that you're buying a calendar spread, because you're hoping that the near month is going to rise, the far month is going to decline. Now, you can also be a scenario whereby the near month and the far month is going to rise together. But the key thing is that the near month is going to rise faster, because it could be supply issue in the immediate term. Maybe there's a worker shortages, which takes some time to bring the supply back. So near term is going to have a big impact on supply, which push prices higher. So near month is going to rise faster than far month. So in this case, it's also the spread is eventually going to get wider as well. Again, this is what we call a bull spread scenario. Now, it could be also both of the contracts are expecting to fall, but the problem is that far month are falling faster. And this is also could be an example of buying a calendar spread, in the sense that the gap between both of the contracts will get even wider. So eventually, when you buy a calendar spread, you're hoping or you're expecting that the price difference between both contracts is going to get wider. As you go back to the front definition, the couple of slides earlier, I did mention that whenever you are trading spread, you're just only looking at the relative value. And if the value, you're expecting the value to get higher or the spread to get wider, eventually you're buying a calendar spread. That's your intention. Now, let's do a reverse scenario. If the near month is expecting to fall and the far month is expecting to rise, normally what you can do is that you are selling the calendar spread. Eventually, the spread difference will get narrow. And that's what your intention to do, a selling a calendar spread. Now, again, you can also expect in a market whereby if you're expecting both calendar contract months are falling and the front month is falling faster than the further month, in this case, you also could be doing a selling calendar spread. So eventually, when you sell calendar spread, you're hoping that the spread will get narrower, or the price difference between both contracts will get narrower, and that's why your focus is to sell a calendar spread, hoping that the price difference will get narrow eventually. Now, This is just to show you the listed contract that's on Bursa Malaysia Exchange. This is on CPO market. So you can clearly see there are contracts listed up to 2025, which is 2 or 3 years ahead. So you can do a lot of various combination. A lot of major focus is a lot of volume concentrated is mainly doing on the September and October contracts. But you can always do a September, October, or October, November, December, January. It doesn't really matter. These listed contracts are all available on the platform. But what is important is that you make sure that you must understand, what are you hoping to achieve whenever you are trading a particular pair of spread. Are you expecting the spread to narrow, or are you expecting the spread to widen? That's important. If you expect the spread to widen because of foreseeable fundamentals or because of technical chart, technically you're buying into a spread, which is in our scenario is called a bull spread. And vice versa, if you're expecting the spread in next couple of weeks going to narrow, then technically you are going to sell a spread. Technically, it's a bear spread scenario. So importantly is that you have a lot of combination that you can do with all the listed contracts, spread contracts that's available on the market. But importantly, I think the major volume and concentration is right now is on the September-October contract. Again, once September is no longer the active month and it shifts over to October, then the most active calendar spread pair will be October and November. So it goes with that kind of sequence. So eventually, if you are new to spread trading, you want to be trading the most active contract. You don't want to be trading contracts that are quite illiquid. So that's where you face a bit of liquidity risk. So importantly, if you are trading new to futures trading or spread trading, be reminded that focus your attention to the most active contract. So right now, the most active month contract is September and October. So that's the pair spread that you should be looking at. So if you have a view that this spread is going to go wider, normally you buy a spread on it. But if you have a view that the spread eventually is going to narrow, normally you'll be selling the spread. So that's how you will be looking at calendar spreads, at the dynamics of it, and when you should buy a spread and when you should be selling a spread. So this is just to show you an example of a calendar spread dynamics. So you can clearly see, if you compare this to outright, obviously, the intraday range is about 30 to 40 ticks. As compared to outright, you're talking about 100 over ticks. So based on the kind of ratio, in a way, spread trading does involve lesser risk. But eventually, you also need to have risk management in place. So what I have here is that if you just notice, this is September and October pair spread chart. If you look at it, you can clearly see there's a very nice pattern going wider. So the spread actually widened back in early April because of the Ukraine conflict and whatnot. So eventually the spread from 20 points difference, it went up to as high as 200 points difference. So if you are thinking that the spread to widen at that point in time, you should be doing a bull spread. But eventually market adjusted. So if you just look at the CPO market of late, the past 2 or 3 weeks, we saw prices adjusted downside. There's news that supply is coming back, labor issue is being resolved and whatnot. Supply is coming on stream, and therefore I think a lot of market participants actually sell onto the market. So therefore I think in itself the spread is adjusted back to its normal average, is about 20 to 40 ticks points difference in terms of the September and October contract. So again, I think this is a very clear-cut example. Whenever situation change, fundamentals changes, and you expect spread to widen, normally it's a very nice trend up. And eventually, when the fundamental get adjusted, when things start to change, the spread will actually narrow quite substantially. So you can clearly see, I think this is a very clear-cut example. It went to as high as 200 points difference. Right now, it's doing about 30 to 40 points difference. So that's how the dynamics of spread. And eventually, importantly, is the volume. So right now, I think September and October contract is considered the active spread pair. And that's where the focus of trading should be. Now, these are some of the key benefits of trading spreads. I think, again, the main emphasis is always lower risk profile. So if you are someone that you want to get exposure of trading outright, you can't take the 100 points volatility on a single day. Try to look at spread, because spread itself, you look at September and October contract, you're talking about 30 to 40 points tick intraday range, high and low. Outright, easily, I think just look at today is about almost 200 points or 200 ticks difference. So outright trading does requires a lot of risk. So if you are someone that is lower risk profile, you don't want to expose to such a substantial risk, you can consider spread trading in general. Secondly, I think in terms of because spread trading requires an opposite position, it becomes a pair. Technically, you are exposed to a lower risk, so therefore the margin requirements are slightly lower. So this one, do check out with some of the exchanges that's listed on that's on Bursa Malaysia exchange platform. Do check out with them because margins requirements do change on quite regular basis. So that's where we need to come. But generally, I think if you are trading on spread, if you compare to outright trading margin, that is usually slightly lower because of the risk that's involved. Now, a lot of people say trading spread requires a lot of fundamental. You need to understand what's the fundamental in September, what's the fundamental in October. Now, that's not necessarily true. I think trading spreads, you just look at the chart itself, you can apply some technical tools that can help you to filter out, whether whether this particular spread is going to be heading on a trend or whether it's going to go on a sideways market. So I think eventually, in spread market, you can obviously use technical tools, certain technical tools that you can apply, like how you apply on the outright position, and you can apply something similar on the spread market as well. So seasonality is something that is very crucial if you're trading commodities. Later on, I'm going to explain more why spread does incorporate certain seasonality pattern. Now, with lower margin, obviously your return profile is going to be higher, but then again, your risk also is going to be elevated. So naturally, if you are exposing yourself to higher risk, your returns are also quite commensurate to the risk that you are exposed with. Again, I emphasize this again, which is very important and very crucial, is always make sure that regardless which market you are trading, whether it's on the outright position or on the spread market, you really need to have a stop loss management. Without proper stop loss management, it's going to be too volatile of a position for you, and you will get stopped out eventually. So make sure that you must have a risk management in place, regardless whether spread trading is considered lower risk. So therefore, you can be quite slack on your risk management, but that's not the case. Market will get volatile, spread will also get volatile. Now, there's a common method for some people. If you want to have a view of the market, and it's a bit longer term, and you want to roll your position or you want to move your position towards the further months, you can actually use spread as well. I'm not going to touch too much on this, but the function of a spread is also helping you to hold a certain position or hold a certain view of the market for more longer term or medium term basis. Now, to illustrate why spread trading is generally classified as lower risk, if you just look at this is August and September's spread chart, and we just look at the August contract, you notice that the bottom of the chart we have an ATR measurement, which is average true range, which measures the range of the particular high and low. Normally for spread, if you just look at the August September spread, is range about 9 to 15 ticks on an hourly chart. Now, if you just look at on the outright basis on the hourly chart, you're talking about 60 ticks. So that's a big difference, almost 10 times. So that's where trading spread generally involve lower risk, and trading outright it expose you to much bigger risk adjustment. Now, I'm not going to go too deep on the definition on the futures terminology, but again, I think if you're trading the futures market, there's always these two market structure that we are always quite accustomed to. One of it is what we call a contango market. Sounds very fancy, but what it means is that in a contango market, the forward price is always higher than your near month prices or your spot prices. So say for example, in a contango market for CPO, flex is that your October contract, which is next month, is higher than your September contract. So generally, in a normal market situation, which means barring any shortage of supply or everything looks normal, supply is normal, demand is normal, commodities should be in a contango market. Now, of course, commodities itself is always back to demand and supply. If the other reverse scenario is what we call a backwardation market. Now, in a backwardation market, it's very simple. It's classified as your farmland contract is lower. So what we are seeing right now is if you just look at the listed contract that's on Bursa Malaysia, if you just look at the current month, say for example, you take September contract, normally it's trading higher than your October contract. So what it means is that your farmland contracts are priced lower. So in this market, we usually call it as a backwardation market. So again, don't be too afraid of the terms. It's just term for it as to the market structure. But what it really tells you is that whenever you see a backwardation market, normally it tells you supply at the current time is very tight. And going forward, more supply is coming on stream. So therefore, it tend to be farmland prices tend to be lower. But again, why this is important? Because if you're trading spread, you need to understand the nature of the curve or the nature of the market structure. So when I say that, what it means is that if you look at all the contracts that's listed on Bursa Malaysia up to 2025, 3 years forward, if you just take the price and you just draw on an Excel sheet, you notice that it's always a curve. Whether contango will be farmland prices are trading higher, backwardation is always farmland trading lower. Important is that when the curve starts to get flatter, normally that tells you that the market is going to go into a structural change. And that's where we really need to be careful if we are doing spread. Because when the market start to change, normally your spread structure will also start to change as well. So it's important for us to track that on an ongoing basis. So I think that's the proper definition of contango and backwardation. Importantly is to make sure what is your current price or current month price compared to your next month price. Is it higher or lower? And that will determine what kind of structure you are in. So like I mentioned, I think in the backwardation market, normally it tells you is that the market journey is bullish in the front month. As we go towards the next couple of months, the market will resume a bit of normality. So that's why the farmland prices are always lower. So normally in this backwardation market, that's what you are witness in CPO market. It tells you that the current market or current situation in the market right now is a tight market, or supply is actually quite tight, or that's why prices in the front month is higher. So again, I think these are all attributable to fundamentals. It could be supply is shrinking because labor issues, the yield of trees are just not producing. Weather could be a big impact and whatnot. So understanding a bit of fundamentals and understanding the structure will give you a bit of will paint you a bit of where the reality of the market situation is. So again, if you just plot all the prices like I mentioned earlier up to 3 years forward, you can clearly see the structure of the curve. And you plot it on a daily basis, you can clearly see how the structure turns out to be. So what I did here was to take the market structure back in April, early April. You notice that the steepness of the curve is actually quite steep in beginning of April. But then again, I think the steepness starts to decrease as we head over into end of May. Reason means because if you recall back the prices of CPO back in early April, that's where the start of the Ukraine-Russia conflict. We saw the first time in history, CPO hit as high as 8,000 ringgit. That's where your farmland prices tend to adjust dramatically. So right now, if you just look at the structure, your farmland prices are trading higher than your farmland. So that tells you the market is actually in the backwardation market. And normally this market tells you is that the farmland supply is very tight. Now, like I mentioned, do pay attention when these curves start to change. So this was taken just a couple of days back. You notice that the curve has totally changed. The front month still display a bit of backwardation market, but you notice the middle contracts, those contracts that's trading on next year forward, those are trading much higher compared to the second half of next year. So this again tells you a different picture. It tells you the market is starting to expect that the supply will likely to resume next year onwards, especially on the second half. So it tells you a lot. By looking at the forward curve, by looking at the market structure, it gives you a sense where the market is heading and what the market participants are thinking. So again, pay attention to all these farmland contract prices, or what we call a forward curve, because it tells you a lot. So if you are trading spread, if you notice this kind of pattern, you don't want to be, shorting a spread, because eventually, the spread between intermonths will get wider. If you are shorting the spread, hoping that the spread to narrow, if it's out of the range, if it's widened further, you probably will be losing a lot of money. So that's where you really need to be careful. Understanding the structure itself gives you a bit of edge as to which pair of spread that you should be looking at. So again, I think these are all is available on Bursa Malaysia website. You can clearly look at it. Informations are all there. So if you just look at the month itself, you compare between the front month and the far month, you notice that the market is still expecting that the current situation is the tightness in the market will still likely to persist. So therefore, I think the near month prices are trading at a much higher price compared to the far month. But what is important and what is key is that the market is assuming that going forward, probably in the next 6 months to 9 months, especially when hit into the first half of next year, the supply should come back and prices will tend to adjust. So that's where we get information from just by looking at the forward curve. And that's important whenever you are doing or try to understand the spread dynamics. So back to the definition, like I mentioned earlier, a bull spread is basically talking about bullish. You're hoping that the spread to widen further, and a bear spread is hoping that the spread will narrow eventually. So like I mentioned, if you just look at September, October, which is the active spread pair right now, if you're thinking that the spread is going to go wider because of reasons like I mentioned earlier, fundamentals are supportive and whatnot, technically you'll be doing a bull spread. So what you're doing is that you long September and short October, hoping that the spread will widen. Now, the reverse scenario is what we call bear spread. Technically, you're going to short a September contract and buy buy October in this case. Sorry for the typo. So in this case, is what we call bear spread, hoping that the spread will narrow eventually. Again, these are all different plays. You have your own. You tend to have your own view why a spread can narrow and why a spread can widen. Be it fundamental or be it just looking at technical chart. But eventually, you need to understand the dynamics of doing a spread. What are you going to be involved in whenever you're doing or looking at the spread dynamics? Now, to show you a classical example, so what I have here is basically August-September CPO spread pair chart. So you notice is that this Heikin-Ashi candles. That's why I don't see any. The trends are very nice and the gaps are all not available, because when you trade Heikin-Ashi, there's no gaps. So if you notice that the Heikin-Ashi is actually pointing very strong green bars. Whenever we look at green colored full body bars, that tells you the market journey on going to be a strong uptrend. So for an uptrend in a spread, that means the price differences between the August contract and the September contract will widen further. So technically, in this scenario, you'll be doing a bear spread or a bull spread. So if you are looking at the market to widen further, normally what you do is you'll be engaging in a bull spread. Now, if you look at as we progress to later months, you notice that the spread starts to get weaker, which means that the spread tend to narrow a little bit further. So when this happens, normally what will you do? So in this scenario, when you expect the spread to narrow further, technically what you're doing is to do a bear spread strategy. So that's how you interpret a bull and bear spread. And that's ultimately what you'll be doing whenever you're looking into a spread dynamics. Now, so again, I think if you just look at the spread itself, really, I think this year we'll see a lot of volatility in the spread dynamics alone. I did mention doing outright trading is volatile enough, but spread, even though it's a lower risk profile, it is volatile. If you just look at July and August CPO spread pair, you notice that it's been trading around 100 points difference, and it broke that range. It went as high as to 400 points in difference between both contracts, which is huge. For a contract just you're talking about 1 month difference, to have a 400 points price difference is quite substantial. But eventually that spread will narrow further. So that's a good opportunity for you to be doing a mean reversion or shorting this particular spread pair. But what I want to show you is that the spread dynamics itself, it's been trading all the while between the 100 and 150 points difference, and eventually it tear, which means it widened further. It widened to as high as 400 points. Well, whenever you look at a spread pair, whether you think 400 is the peak, it may not be the peak. It can be even higher. So what's important is that to apply certain technical tools that you can apply to a spread chart and to find your possible entry or exit positions. So again, despite outright being quite volatile, the spread pair itself does display a bit of volatility as well, and it's an important point to take note as well. Now, so I mentioned a lot on different calendar, different months, which is focusing on calendar spread. Just want to touch a little bit on inter-commodity, which is talking here the spread between the soybean oil and palm oil. Now I know a lot of people who've been trading the palm oil market is looking at this spread. Eventually when you have premium market, which means soybean oil trading at a premium to palm oil, which is quite common. Normally in market convention, soybean oil does command a lot of premium as compared to palm oil. But again, the average premium between the soybean oil to palm oil is about $150, historically speaking, over the past 10 to 15 years. So if you are someone who is, looking at the spread, and when you see extreme, like I think it was trading $650, I think that was the highest in history, if I'm not mistaken. It was June 2021. For reasons, I think CPO was actually quite depressed, and a lot of people are actually pushing up bean oil because of the green energy, the Biden policy, and whatnot. So it pushed the spread to as high as $600. That's quite a hefty premium. But eventually, if you given time, I think palm oil did do a catch up, and it has actually traded to as low as close to parity, which is zero. Eventually, that kind of condition also will not last. And eventually now we are back up to about 300 to 400 US dollars. So what I'm trying to tell you is that just by looking at this spread dynamics between soybean oil and palm oil, it gives you a lot of opportunity. Whenever you see a high premium, especially towards 400, 500, it won't be sustainable. And eventually what that tells you is that palm oil is quite undervalued. We have seen that. I think the palm oil, this spread was doing about 400. Eventually now it's adjusted about 350 to 300. And I think palm oil did do a catch up. So again, I think you can use this as a guiding principle. Or even you can use this, you can even look this dynamics to try to trade on a palm oil basis. But it's important. I think you can do a intercommodity spread by looking at soybean oil and palm oil spread itself. So I'm just going a little bit on technical setups. So I mentioned earlier, you can actually apply technical reading or technical tools on spread trading itself. So not necessarily, you have to limit yourself to understanding the fundamentals of different months, but you can actually apply technical tools, simple technical tools that can help you to identify better exit and entry and exit positions. So this is basically two contract price. One is the August CPO contract, and one September CPO contract. If you notice, the gap itself is actually quite wide back in early part of this year, but eventually it narrowed. So if you're trading spread, you're talking about the difference between two particular contracts, and that's what you are be focusing more about. So if you just look at this spread chart, again, you can clearly see towards the early part of the year, the spread between these two contracts was actually close to zero. There's no price difference. But as we hit into February, March, you can start to see the spread starts to get wider. And it really tear, especially in early April. That's where the start of the Ukraine and Russia conflict. But eventually, the spread is not sustainable, and it went down to 20 to 30 points as what you are trading right now. So this goes to show you that the spread dynamics itself, it gives you a point. You just based on certain trend, it's quite trendy. And if you are looking on an hourly basis to trade on a spread pair, it does give you a bit of opportunity because the trend is actually quite apparent. If you compare to outright is quite volatile. One day it could be opening higher, the other day it could be opening lower. So that's a lot of huge, or rather I'll call it quite a big shift in the market momentum. So setting up calendar trading strategy, I think these are some of the key technical attributes that you can apply. Technically, you can do your your own research by just looking at some of the key things that I highlighted here. So I think the first thing is that if you compare to spread and you compare to outright trading, spread itself tends to display a bit more trendy pattern, in a sense that there's certain period where the trend tend to stay for the spread contract as compared to outright. Like I mentioned earlier, outright there will be a day where it's uptrend, the next day it could be a downtrend. So that's how volatile it is on an outright basis. So what's important is that first is to identify the trend. Now there's a lot of ways to identify the trend. Since spreads are quite only active up to the listed contract or the month itself. So if you're talking about August, September, technically, once September is no longer the active contract, then this pair will diminish in volume, and therefore you need to look at other active pairs. So generally, if you want to identify trend, there's a couple of ways. One is to look at it visually. Another way is to apply EMA, which is quite standard. You can apply a 50 period EMA, or you can apply a 200 period EMA. Now, 200 period EMA is a bit too long. So what I would suggest is to apply a 50 period EMA, because that will covers you at least two months of period, which is good enough for you to identify the trend of a particular spread. So once you identify a trend, I always preach this is that you need to be trading on the side of the trend. If the trend is showing you upward movement, uptrend, you should be finding position for you to long. If the trend is downside, you better find a position for you to short an entry position. If it's a sideways market, then use a different strategy. Importantly is that if it's be trading with the trend and not against the trend, because trading against the trend is always a difficult business. You tend to get a lot of whipsaw, and once the market's against you, it tend to be against you quite substantially, and that's where you need to be careful. So once you identify the trend, I think next is to identify point for you to enter and exit. You can use this using a moving average crossovers, and you can couple with that Heikin-Ashi. Now I'm quite a big fan of Heikin-Ashi because if you look at Japanese candlesticks, there's a lot of disadvantages, which I'm going to share to you earlier. And I think Heikin-Ashi, if you're talking about trend trading, it does help you to identify the trend in a clearer manner. So in a way that you can see the trend better, and it can depict to you more visually. So in a sense that when the trend changes, when the trend start to peak, and that's where you need to be getting out of positions. So you incorporate that with moving average crossovers. I think that will be quite a good entry and exit system for you to look at. And last but not least, you must manage your risk, like I mentioned earlier. And one of the way is to use a technical tool, what we call average true range. So now, just to give you a sense of it, if you just look at the movement between the outright contract, in this example, we have the August contract, and if you compare with the spread contract, which is the August-September contract, you notice they tend to move quite in the same direction. So whenever outright moves higher, your spread will get wider. When outright tends to fall, your spread will tend to get narrower. So that's the spread dynamics. Whether the correlationship will hold most of the time, I would say pretty much most of the time you'll hold, but there will be periods of time where the spread doesn't really follow with outright movement. But it does give you a sense of direction. It does give you a sense of how outright movement will affect your spread movement. So I think this is comparing the outright and the spread. So I think visually we can always look at whether the market is showing an uptrend or downtrend by looking the peaks and the troughs. If the peaks are getting higher, normally that tells you the market is generally going to be uptrend. If the peaks are getting lower, that tells you that the market is generally going to be on the downtrend. And if you can't identify, the peaks are pretty much similar on a particular level, generally the market is on a sideways market, and that's where you need to use a different type of strategy, which is more accustomed to sideways market. So again, you look at this by visually. You look at this particular spread pair, the August and September. You notice that they are making lower lows, and the peaks are also lower. So that means I think generally the market is on a downtrend. But that quickly reverse. Then I think you notice that one section of the area, the lows are getting higher, the peaks are also getting higher. Generally the market is going to change from a downtrend to an uptrend. So one way is to depict the trend by looking at it visually and looking at the peaks and troughs. Now, another way to look at it is to apply a 50-period EMA. The reason I'm not using 200-period EMA because if you're trading spread, there's expiry on a particular contract. So again, I think having a too long-term basis doesn't really gel with a spread contract. So 50-period is sufficient for you to cover a 2 months period. So in a sense that it does give you quite a good pointer as to what kind of moving average you are looking at. So if you just look at this 50-period EMA, you notice that whenever prices are trading below the period moving EMA period, that it tells you, generally the market's on a downtrend. And if the candles are trading above, generally that tells you the market's on an uptrend. So you're using the 50-period EMA to determine whether the market is on an uptrend or a downtrend basis. So generally, I think not only that, you can use the 50-period EMA as a point of support and resistance. So as long as prices are trading and holding well above the 50-period EMA, that tells you the uptrend is still intact. Again, normally it will tend to retest the 50-period EMA. If it does break below that, generally that tells you the market's on a downtrend. So not only the 50-period EMA is giving you helping you to identify the trend of the market, it also tells you where are the point of support and resistance based on the EMA level. So you can clearly see, I think these are quite a good examples. You can clearly see the price is well supported above the 50-period EMA. It does eventually break it, so that tells you there's a potential downtrend. And eventually it tried to retest the 50-period EMA and it failed until there's a green bar on Aiken sheet and it broke the 50-period EMA. That's where it's quite a definite uptrend on the spread itself. So eventually the spread widened quite substantially. So that's how we use a 50-period EMA to really apply into the spread chart itself. Now, to add, I mean, this is just on a side note, but whenever you are trading a trend, it's important to know whether you should be entering the trend when it's quite strong. When a trend starts to get weaker, normally that's where you tend to do opposite or tend to exit your position if you have any. So one way to identify the strength of the trend is to look into ADX indicator, which is available on most charting platform. So whenever you see rising ADX value, that tells you the market, the trend or the strength is generally quite strong. Anything above 20, that tells you the market is trending. If anything below 20 on ADX value, that tells you the market generally is on the sideways market. So the funny thing is that, you have high ADX value, especially on a downtrend, that tells you the downtrend is quite intact. And the downtrend strength is quite strong. Same goes if you're on an uptrend, you will see ADX value rising, that tells you the uptrend is actually quite supported. So ADX value could be something that you can use to accompany with your analysis, especially when you're measuring the trend or the strength of the trend, sorry. So again, I think besides that, one can obviously look at volume profile. So if you're looking at a particular trend, if it's accompanied by rising volume, so say for example, you look at here, you have a strong rally on the spread itself, the volume is also rising, that tells you generally the uptrend is quite supported. Crucial to watch is that the downtrend, if the downtrend, whether it's a correction of a rally or whether it's a proper downtrend, you can look at the volume. If the volume are rising on the downtrend, especially after a long rally, that tells you market is generally going to be on the downtrend. It's going to change trend. So that's why you can use volume profile, as a way for you to gauge whether the particular trend is in your favor or everybody's participating in the particular trend of the market. So volume is a very good indication. So now, if I just to show you an exhibit between A and B, if you just look at the chart itself, a naked chart itself, and if you are trading it, which particular chart will be a better chart for you to trade the market, especially when it comes to trend. Is it exhibit A or exhibit B? Maybe, just feel free to type a response. I just want to get the feedback from the audience, which particular, chart that is more apparent to you when it comes to trend trading. Yep, I can see some responses coming in, and I think majority will agree that exhibit B is actually a better chart for you to trade. Now, if you compare Exhibit A and Exhibit B, Exhibit A, actually both of them are the same time frame, same product. The only difference is that Exhibit A is your normal Japanese candlesticks. Exhibit B is to use the slightly derivation of Japanese candlesticks, which is what we call Heiken Ashi. They always use the average bar of your Japanese candlesticks. You notice that when you use Japanese candlesticks, there's a lot of gap. When you use Heiken Ashi, it's smoothen out the gap. You can't see the gap at all. But what's crucial to take note is that when it helps to, because it takes a middle average of the candlestick bar, your Japanese candlestick bar, technically highlight the overall trend of the market. So if you see a downtrend in the market, you're shorting the market. As long as Heiken Ashi is showing you a red candle, full body red candle, you should be holding short to your position until the candle has changed to a different color or the body of the candle is getting shorter. That's where you need to be careful. That tells you normally the trend is going sideways, and that's where that'll be a good time, a good point for you to be exiting your short position. So Heiken Ashi is very clear cut. It helps you to identify or to show you the trend at that point in time in quite a clearer manner as compared to candlesticks. So I'm not going to go the mathematics on how to derive Heiken Ashi. You can get this from the internet. You can Google it, obviously. But what's important to take note is that Heiken Ashi, you're always taking the average or the middle bar of Japanese candlesticks. So in a way, it discounts the gaps and it discounts whipsaw patterns and it turn it into the longer term trend time frame. So that in a sense that if you are downtrend, you're holding a short position, you can quite rely on Heiken Ashi to tell you whether the trend has changed or whether the trend is still in your favor. Now, in a sense that I think if you compare to Japanese candlesticks, whenever you use Heiken Ashi, there's only three major attributes that you need to know. Basically, if you see there's top and bottom wicks on a particular Heiken Ashi candle, that tells you the strength is actually getting weaker. So that's where you need to be careful. Normally, if you only see one candle, normally that tells you the trend is still very strong. If you see no candles at all, no wicks at all on a particular candle, that tells you the strength, the trend of the strength is actually very strong. If you see a short body, like almost like a doji type candle, that tells you the market is actually on a sideways market. So there's actually three distinct patterns whenever you use Heiken Ashi. If you use Japanese candlesticks, there's various configuration you need to know. And there's 100 overs type or different type of candlestick formation that you need to be mindful of if you are trading using the Japanese candlesticks. So whenever you look at Heiken Ashi, it's actually quite simple. And in the sense that it does illustrate to you what is a particular trend at that point in time in a clearer manner. So to give you the dynamics of it, if you see green colored body bars with only a single wick, that tells you the trend is still very strong on the upside. Vice versa, if you look at the red body bars with only single wick, that tells you generally the market is still on a downtrend. Reversals that's where you start to see like doji type of candles, and you start to see different type of candles on each subsequent time frame, and that's where that will tell you the market is actually going on a sideways market. And normally that during that time you'll be using your sideways trading market strategy. So this is basically using Heiken Ashi dynamics. Notice that whenever the color of the Heiken Ashi is showing you green, that generally tells you the market's on the uptrend. If the Heiken Ashi is showing you red, generally that tells you the market is on the downtrend. So it's quite simple in a sense to recognize the trend. And whenever you are holding a long position, as long as the candles are still showing you green candles, and the candles are quite long, that generally tells you the strength of the trend is still there and the trend will continue. Just be mindful whenever the trend starts to change by showing you shorter body or by showing you different type of going in a sideways range where different type of colored body candles, that's where the market generally will go in the sideways market. So this again illustrates why using Heiken Ashi is much simpler if you compare to using Japanese candlesticks. Again, I think it's more of a combination. And I think when you look at Japanese candlesticks, the interpretation of it requires a bit of art. Heiken Ashi is a simple mathematical formula. So if it's on the uptrend, it's shown by the green colored candle bar. If it's on the downtrend, it's shown by the red colored candle bar. So again, I think that's the main advantage of using Heiken Ashi. Now, if you are someone that's using gap trading as a strategy, if you want to look at the gaps, you can't use Heiken Ashi because Heiken Ashi will discount the gaps. So that's a major disadvantage. You are using gap trading strategy whenever you're looking at the chart. So that's where we really need to be mindful of if you're using Heiken Ashi and candlestick and Japanese candlesticks. So again, a classical example, whenever you see a series of red and green colored candles, that normally tells you the market is on a side range market. Again, I think Heiken actually does do a good job whenever the trends start to change. You can clearly see, I think this is a 30 minutes time frame on a Heiken Ashi on August-September spread pair. Notice that when the spread starts to get wider, the trend normally generally will be quite persistent until the market goes in a sideways market again. So again, this goes to show you, generally when spread tend to trend, the trend can be quite persistent. So it gives you a lot of opportunity for you to be in the market. But you have to be mindful if the trends start to change. That's where you really need to be mindful whenever the trends start to change. So now, I think Heiken Ashi itself may not be a good combination, but if you combine them with moving average crossovers, I think that would be even better combination. So I'm not going to go too deep on the definition of moving averages. You can obviously get more in-depth information on the internet. But generally, I think moving averages, there's a lot of types. Majority or mainly I use is always the exponential moving average, which gives you a bit more, or rather it reflects more of the current series of prices as compared to if you just use a simple moving average, normally the price reflection will tend to be slower. So you can clearly see here, comparing using the different type of moving averages, normally the simple moving average tend to be a bit more lag as compared to exponential moving average. So in a sense that, majority of my examples, when I talk about moving averages, I'll be referring to an exponential type of moving averages. So I think for moving average strategy, what I did use is to compare two periods. One is the 9 period, which is a shorter term, and the other period is 20 period EMA. So crossovers are simple. Whenever you have a bullish crossovers, which means the 9 period is crossing above the longer term 20 period EMA, that usually be a signal for you to be entering a long position. So you couple with that with a green colored Heiken Ashi bar, that will be a very good entry for you to be taking a long position. Vice versa, if you look at a bearish crossover on your moving average, that tells you generally, the markets go on a further downtrend. You couple with that with a red Heiken Ashi bar, that's going to be quite a good entry for you to be shorting the market. So some simple setups by using the crossovers. So you can clearly see there's a bullish crossover here, whereby your 9 period is almost touching or crossing above the 20 period EMA, and you can see a green colored Heiken Ashi bars. That will be a good entry for you to take a long position. Now, not only the 9 period EMA and the 20 period EMA gives you the entry and exit signals. In a way, these EMAs are also providing you the support and resistance level as well. So as long as the candles are trading above these two periods, technically it tells you the market is generally on an uptrend. And if it's trading below, generally that tells you the market is on a downtrend. And as long as it doesn't break any of the lines, that tells you generally the market will face either you'll face the average line as a resistance, or face the moving average line as a support. So eventually it acts as a support and resistance level as well by looking at the moving averages. So last but not least, in terms of risk, in terms of your trading strategy, is to incorporate risk management. So like I mentioned earlier on a slide, one of the best way to manage your risk is to apply what we call ATR, average true range. So technically, it's taking the high and low of the day and calculate it on the period basis. So again, I think I'm not going to go too much or too in depth on the derivation of ATR. But what's important is that ATR helps you to monitor your risk to reward ratio. So normally, for someone that's looking at the market, you should be targeting 2 to 1, which means that your reward to risk is 2 times. So if let's say your ATR value is 10 points, which means the intraday volatility is about 10 points, and you want to get a 2 to 1 reward to risk ratio, you should be looking at 20 points profit every time you enter a particular position by just looking at the ATR value. So in the sense that as long as market is not volatile, your ATR value is going to be low. But when your ATR value will get higher, especially when market gets a bit volatile. So that's where you tend to adjust your ATR value to reflect the volatility of the market. So like I mentioned earlier, I think really the CPO market this year is we have seen the volatility is actually quite crazy. I think the ATR value itself, we just look at outright. You're talking about per day basis is 300 to 400 points. I think this is one of the highest in history. So really, I think this year, it's a very whenever you are facing a high volatility market, normally it tells you there's opportunity in the market. But then again, opportunity comes with a risk as well. If you don't manage your risk well, you tend to get a lot of whipsaw and you tend to get stop out. So that's where ATR is important as a tool for you to manage your risk. So be prepared. If your market is getting more volatile but higher ATR value, that means your risk tolerance has to be higher as well. So again, I think spread market is also displaying the kind of volatility because outright is also getting volatile. Naturally, the spread contract will also get more volatile if you compare to historical terms. But if you compare to outright basis, you can't compare because outright you're talking about 400 points on a daily basis. Spread itself is only moving about 60 to 100 points per day. That's the peak of a movement. So again, I think the risk profile is slightly different. Here it goes to show you, I think spread itself, I think it's this year also we've seen the highest historical volatility in terms of the spread contract itself. So it goes to show you, how volatile it is. Whether it's on the outright market, it's also affecting on the spread market itself. So therefore, it's more important for you to have a proper risk management in place. So how to use ATR? Again, I think this is basically, one way is to, whenever you look at this, there's a buy signal by looking at bullish crossovers, and you look at the green Heikin, that generally tells you that the spread will widen further, and that will be a good entry point. Now, if you just look at the ATR value at that point in time, it's about 7 points. Again, these are all matter of time frame. The time frame I'm using here is actually 30 minutes. So you're looking at about 7 points, difference on the 30 minutes time frame. So if you're looking at it, you've got an entry signal, you've got a long entry signal, assuming that you enter at 110, and your profit target should be 2 to 1. You're working on that ratio. That means you're aiming for 14 ticks of profit, with 7 ticks of loss or stop loss in place. So that's how you work using your ATR to manage your risk. So again, once the ATR values start to increase, normally you have to be prepared to absorb higher risk or higher ATR value. So eventually you have to increase your risk profile. So basically these are all trading setups. Again, I think if you incorporate moving average crossovers with the Heikin, actually it gives you a quite good signal for you to enter and exit the market. And if you couple with that ATR, it helps you to manage your risk in a better way. As long as the market is more volatile, you have to be prepared to adjust your risk preference accordingly. I think the standard technical patterns still apply. You just look at, I think this was on August and September spread pair. There's a clear head and shoulder pattern. So really it's testing on the neckline itself. In fact, I think it's more of a double top rather than head and shoulder. So really, I think certain technical patterns still apply whenever it comes to spread trading. I think these are, if you look at the calendar spread now, this is interesting. If you notice that the current contracts or spread contract that's listed on Bursa Malaysia, you notice the front contracts are actually trading quite high. Obviously, this was taken back in early May, where the front month contracts, spread contracts are trading about 200, 300 points difference. Obviously, that has changed after market has adjusted. Right now, the front month contracts are still doing about 70 to 50 points difference. What is important to take note is that the curve itself has actually went into negative territory, especially for 5 month contracts. So it goes to tell you that the market going forward is expecting that the supply will return and prices of further months is going to be lower than your current month. Therefore, if you look at further contracts itself, technically you are going into pretty much a contango market for the further month contracts. But naturally, if you compare the curve itself, the curve structure has actually changed quite substantially over the couple of weeks. I'm just not going to go touch too much on fundamentals. I'm going to touch briefly on certain aspects to look at, especially as we hit into the next couple of weeks. Now, if you just look at why I said CPO is quite a common display, quite a common seasonality pattern. Just look at production. it's quite clear cut. If you enter around May-June period, normally that's rising production period right until October. So if you are doing a spread contract, you have to be careful. You notice that whenever you're facing rising production, normally that particular month itself will be weak. So that's where you need to be careful. If you're thinking of buying or thinking a spread to widen further, you should be careful what the fundamentals are for the particular contract that's involved. So production is very clear cut. Around May to August or September period is usually rising production. This year looks like it's going to be following historical pattern. There's nothing to tell you that it will not be any year different. But again, there's still challenges that's being heard in the market. Obviously, it's labor shortages, the youth productivity is actually generally quite low and whatnot. So I think that's something for us to take note. I think I'm not going to go too much on what's the expectation of production. Again, I think everybody's expecting production will come back either this year or most probably be the first half of next year when production will start to resume. And that's where, prices will tend to adjust on the downside. Now, I just like to show you this chart. I think it's interesting in the sense that, a lot of people has been saying that, well, if CPO were to go back to its normal supply and demand situation, not bearing unforeseen circumstances, are we able to see the 2000 price level again? Now, for me, I think based on fundamental perspective, is a bit tough, given the fact that if you just look at over the historical past 20 years in terms of price performance, you do notice that the average prices actually start to increase over the decade. And we just I too bad I don't have the chart that show you the cost of production. The cost of production of CPU is actually rising. In fact, I think over the past 3 to 4 years, actually rising quite rapidly. So this goes to tell you is that prices can decline or can see a correction, but eventually the floor of the particular price level for CPU will start rising because the cost of producing is no longer cheap as compared to a decade ago. And with rising cost of production, that will be the possible floor for CPU. So I think right now you're looking at about 2,500 for the past for the past 10 years. I think last 3 years, these 3 years has totally changed the ball game. Definitely you're looking at about close to 3,000 as an average. So that's where we really need to be concerned of. If you look at there's a correction in the market, normally the floor will pretty much be reflecting on the fundamental or the cost of production. So again, this is basically to show you the CPU price and stock level. As long as you have low stock levels, that will tell you generally the price will tend to be supported. So right now, the stock levels in the country are still low. So therefore, I think price will tend to be strong. It's a bit difficult for price to adjust on the downside. Export wise, I think export seems to be sluggish. The reason why we have seen the correction, the steep correction of 6,000 ringgit to right now where we are seeing 4,000 or 5,000 ringgit per ton is because I think when Indonesia starts to release the export ban and start to release their supply of palm oil in the market, it really shifts the attention away from Malaysia. So I think in terms of export trend, going forward, it's going to be a bit slow. Now, when it comes to export demand, normally China and India is the biggest. China is really the key driver here. If China continue with their zero COVID policy, that's going to make it a bit difficult because as long as they want to lock down their cities, especially when cases are rising, it's going to affect demand. So that's where you need to be aware of. As long as exports are not strong, price can't go any way higher. So again, I think you look at China and India being the major bargain. Although obviously their stock levels are low at the port, but they are not demanding for Malaysia palm. I think that's why prices tend to be a bit more sluggish this couple of weeks. So let's see going forward if price adjusted or quite good discount right now. Let's see whether they'll resume buying. If that's the case, I think likely we will start to see exports start to pick up going in the next couple of weeks. Now, the reason I want to highlight this government policy, especially from Indonesia, is that if you notice why volatility in the market has been so quite sharp recently, is because any news that's coming out from Indonesia is going to affect the BMD market quite badly. We notice how, especially during the beginning of the year, when they imposed the ban, you see how sharp of the rise in BMD. So that's important for us to take note. Again, I think these are all unpredictable. Government policies can come in anytime they want, according to their whim and fancy. So really, I think this is a question. You are trading the market is something for you to watch out for. So if you just look at seasonality, now this is important if you are trading spread. You notice that over the past 20 years or so, if you compare January to February, January to December, notice that December is very a strong period for CPO. This is talking about spot or a spot month, not talking about calendar contract on CPO. It's talking about a spot month itself. When it comes to December period, normally it's not a good time for you to short the market because generally the historical pattern has shown you, with lower production, stock levels are low, exports tend to be stronger because of festivities. CPO prices tend to be stronger. This is historical pattern. In June, July period, normally June is always the sharpest, or rather the weak period in CPO market. And true enough, we are just only two days away from June. And in fact, I think this year June period is one of the highest volatility in history, if I'm not mistaken. You're talking about 20 to 25% change in market on a monthly basis. That's quite substantial. So I think it goes to show you, really, you can use this seasonality as a tool to guide you when is a particular period that is strong in the CPO market and which particular period is weak in the CPO market. So I discussed this earlier on, so I'm not going to repeat this again. So I mean, coming back and to conclude in the end is trading spread is not as complicated as trading outright. In fact, you just look at the risk profile itself, it's generally a lower risk profile. Because ultimately if you're doing spread contract, you're doing a simultaneous contract, you're buying in one position and shorting the other position. So generally your risk profile is lower. But nevertheless, if you just look at what I've shown you earlier, the historical pattern, the spread itself also can be quite volatile because the outright contract has actually increased their volatility. So therefore, the spread itself has also experienced higher volatility. So I'm just going to end it here with one quote. It's quite a good book if you are someone that's new to trading and you want to learn more about the trading journey. Jared Tendler is a very good author on mind psychology. So he wrote a book called Mental Game of Trading. I think if you haven't read this book, I think you should read it. If you want to kickstart your trading journey, this is a good book to start off with. So again, trading is a journey, and a lot of people has been complaining, it's a tough journey. True enough, it's tough, but majority of the problem when it comes to trading is actually down to psychology. So really, I think emotional is not the problem. The key is to master your game, which is master your mind. So with that, I'm just gonna end here and open for Q&A. So I'm just gonna hand over to CY for any Q&A from the audience.